Hi, everyone. I'll be conducting this 30 minutes webinar starting now. I'm James, Market Strategist at uSMART Securities. Hope all of you are doing well. Welcome to Talk Stocks with James series. It's now a good time to own Visa amid growing consumer spending. And also keep in mind that our webinar is conducted every alternate Thursday, 7:30 p.m. The next one would be March 16, and on March 30 and April 1st, we will be collaborating with SGS to talk about Singapore listed stocks and ETF as well. So stay tuned for that. And recently we have been uploading our webinar on our YouTube channel. If you miss out any more of our webinars, we got you covered. You can listen to the replay on YouTube. Let me begin with disclaimer first. This presentation is for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. And it has been a while since I last provided an update on US stock market. So I'll be talking about US stock market briefly before spending more time on Visa stock analysis. So in terms of year-to-date performance, we could see that STI returned 0.44% so far. US S&P 500 returned 3%. All country world index ETF returned 4%. And gold returned 0.6%. And the saving grace here is Singapore S-REITs. Singapore REITs returned with about 6%. And we could also see that European country also return about 8% return as well. So so far this year is doing okay. And in terms of sector in US, we could see that technology sectors, consumer discretionary and communications are doing fine this year, has been pulling up the S&P 500 performance. But I would say that probably in the first half of the year, it's best that you could have more defensive sectors like utilities, consumer staple, and healthcare to help you cruise through the first half. Because basically, I think US stocks market will hit its bottom at some point in the first half. Then when it hit the bottoms, try to allocate more on technology, consumer discretionary, and communication in anticipation for a better second half. Here is to show you how to know if this bear market is ending. My argument is you can look at these 5 points. Number one, we need to see Federal Reserve turns dovish. However, Fed remains hawkish. From the latest CME Fed Watch shows that investors are expecting a higher terminal rate in the range of 5.5% to 5.75%. Basically, it means that in the next FOMC meeting in March, you will see a hike of 25 basis points, and the next one would be another 25 basis point, and the following two FOMC meeting, you could also see another 225 basis point hike as well. And okay, I think this is a bit outdated, but basically, right, there is still a possibility of reducing the rate in December itself. Again, this is bad news. I would say that previously S&P 500 in the beginning of February once went up close to 9%, and now it's doing about 3%. Because at that point of time in February, everyone was expecting a lower terminal rate at probably 5% to 5.25%, and to cut rate in December FOMC meeting. But based on the latest prediction that we could see over here, right, we will be seeing higher rates for longer, and hence I think US stocks should come down some more. Number two, we were hoping to see a collapse in inflation, but the data from January actually shows that the inflation is higher than anticipated. if we were to look at the year-on-year changes in CPI, PPI, and PCE, they all indicate to you that the downward trend momentum is slowing down. And the wild card here is China reopening. For example, China reopening may cause higher oil price and push global inflation higher. Thirdly, I reckon that falling USD will benefit US stocks and emerging market. US dollar index tend to have an inverse correlation with US stocks. And by looking at the chart over here, US dollar may actually move higher from now first, and hence we could be seeing US stocks to continue to trend lower now. The theory behind this is whenever US stocks appreciated, it will hurt the S&P 500 companies' earnings, like what I mentioned in the previous webinar itself. Fourthly, we also want to see earnings bottom, but I think a lot of Wall Street analysts have not yet adjusted their earnings expectations low enough. There could be more earnings downgrade. For now, the S&P 500 earnings estimates in 2023, according to FactSet, is getting lower, is still getting lower and lower, which actually tells you that the earnings has not hit its bottom. Lastly, recently I have been looking at the equity risk premium. So in the past, it has been observed that whenever the equity risk premium reaches close to 6%, the S&P 500 usually hits its bottom. So this happened in 2008, 2011, and 2020 as well. So personally, I want to see higher equity risk premium, this number to trend higher, like maybe above 4%, to make stocks attractive again. All in all, I think the equity risk premium is trading at 1.7% at the moment, which is indicating that the stocks doesn't really look attractive enough. This is why I don't think it's likely that stocks can just go higher from now itself. And I also want to quickly talk about the NAAIM exposure index, which indicate the average exposure to the US equity markets by active fund managers. To put it simply, it tells you that how much equity exposure the active funds managers are holding now. So we could see from here, it has come down lately from 80% to 60%. And it shows you that the active fund manager has started to reduce their holdings. So basically, I think it's best to be a bit cautious now. I still think that S&P 500 should hit its bottom in the first half of the year rather than the second half itself. So I probably want to urge you to be a bit more cautious now. Next, let's look at Visa. I know it sounds probably boring to a lot of investors, and growth investor like you probably prefers other payment stocks like Yearn, Affirm, Square, or even PayPal. But still, I think Visa is one of the defensive names in payment industry that you should think about owning it first, because you might want to own something safe in the payment industry first before investing in those offensive names like Square itself. I think the payment industry often has fierce competitions. Every companies just want to get in once a piece of it. So it's relatively difficult to identify a winner in the offensive names. And this is why I think Visa is one of the better names out there. According to Bloomberg consensus, currently 37 analysts recommend buy, 4 analysts recommend hold, and 1 recommends sell. The upside potential is 20+% with a target price of $263 at the moment. Visa, so what is Visa? Visa basically operates a payment processing network that enables transaction between consumers and businesses. Basically, if corporations wants into the Visa network, they will gain access to a network of 3.7 billion cards, 15,000 financial institutions, more than 30 million merchant locations in more than 200 countries and territories worldwide. Visa business model involve charging fees to financial institutions such as banks for using their payment processing services. Visa, on the contrary, does not issue any credit cards. It also does not provide any credit to consumers, which means Visa as a company does not earn interest income or any late payment fees you as a consumer incur on the credit card itself. Visa operates in a four-party model that includes issuers, acquire, merchant, and cardholders. Let me quickly explain all these four parties. The issuers is a financial institutions that issues Visa cards like DBS Bank, OCBC banks. The acquire is basically the financial institutions that enroll merchants to accept Visa payments and to process the payments on their behalf, and to ensure that the merchant are paid for each transaction. Merchant is the retailer, the restaurant that accepts Visa as a payment through the point of sales or online transactions. The cardholder is basically you, the consumer, who own and use the Visa credit card or debit card itself. So you can basically think of Visa as the middleman in this four-party model. The four-party model is the core of the payment system, but when other entities engage in this model itself, right, it will become known as the open loop system. For example, merchant gateway, also known as payment gateway, sends the cardholder's payment data to the acquirer. And a payment gateway is basically a technology that enables merchants to accept electronic payments from consumers for goods and services. It actually acts as a bridge between the merchant website and point of sale system and the payment processor that processes the payment itself. Technology provider ensure the security of the transactions. Payment processors perform transaction authorizations and processing services, account record keeping for the cardholders and acquirers itself. So all these parties work together to ensure the payments are processed securely and efficiently itself. So here is to show you some company involved in the payment ecosystems, and Visa belongs to the credit card network. And the direct competitors include Mastercard, American Express, and Discover itself. And at this moment, I believe most investors are probably more excited about the payment gateway companies like Orion, Square, PayPal itself. Personally, I think it's best to own some network companies first in the payment landscape. And if you were to look at some prominent investors like Warren Buffett, he owns American Express, Mastercard, and Visa. All in all, not only a lot of passive funds, ETFs, are holding Visa, I also see a lot of active fund managers hold Visas. If not Visa itself, I would say that those active fund managers would probably own Mastercard. Here are the top 3 reasons I think you should include Visa in your portfolio. They are market leaders, high profit margin, and high free cash flow. So Visa is the payment industry leader. So according to Research and Markets, the worldwide credit card payment is anticipated to reach 762 billion by 2027 and from 477 billion in 2021 with a CAGR of 8.1%. And Visa is one of the best company or the best company to benefit from this growth itself. It's currently the market leader in the global network cards with a 39% market share based on purchase transaction. UnionPay is the runner-up with 34% market share. Mastercard has a market share of 24%. And in the United States, Visa dominates the transaction volume market, holding about 61% of the market. Runner-up is Mastercard with 25% market share. And you could see that Visa is the only player here among the 4 players that has been increasing its market share. The market share has grown from 52% in 2007 to 61% in 2021. According to Nielsen report, the card payment network is expected to generate a purchase volume of 14 trillion in 2026 in US itself, of which 7.3 trillion will be contributed by Visa. It is an increase of 42% from 2021. Mastercard, on the other hand, is expected to grow 47% from 2021 to 2026 in terms of this purchase volume itself. And now let's talk about the business model. Again, like I say, Visa does not issue credit card, set cardholder fees or interest rates, or make loans to the cardholders. Visa mainly derives the revenue from fees paid by financial institutions, clients based on the purchase, the payment volumes, and the transaction that Visa processes and other related service itself. There are 4 main parts of revenue. There are service revenue, data processing revenue, international transaction revenue, and other revenue. Service revenue itself is basically what earned by Visa for services provided to customer and uses the company's payment network. And then they depend mainly on the payment volume itself. And Visa basically earn 0.11% out of the payment volume. In financial year 2022, the payment volume processed by Visa was 11 trillion. Of this amount, Visa earned $13 billion. Yes, $13 billion, which amount to 0.11% service fee yield. So basically, you just get 11 trillion divided by 13 billion, then you get 0.11% service fee yield. And the good thing is, payment volume is growing at 9.6% CAGR, and the service revenue is also growing at almost the same rate at 10.8% itself. And again, the payment volume is related to inflation, meaning to say inflation will make your products and services more expensive. And as a result, the payment volume will likely increase. So to put it simply for you, the more products cost, the more money Visa makes. So the theory here is, if you think that inflation is destined to stay higher for longer, like I do, then naturally, Visa is going to make a lot more money in the service revenue segment. Just to clarify, I believe that inflation has hit its peak, but it probably will stay elevated for longer than expected, meaning to say, probably for the next few years, inflation in US will stay above 2% itself. And next, we also want to look at data processing revenue. Basically, it's based on the number of transactions made on Visa network, regardless of the dollar amount. Visa earns a flat fee per transaction for settling transaction and transferring funds between banks for authorization, curing, settlements, network access that facilitate each transaction. And the fees per transaction that Visa made is about 7 cents. There are 192 billion transactions processed by Visa in 2022, and Visa earned 14 billion in total. Yes, Visa earned 14 billion in total, which is about 7 cents per transaction. The 5-year CAGR for payment processing transaction is 11%, and the CAGR for this data transaction, data processing revenue is 13% itself. The third revenue source is international transaction revenue. Like the name suggested, it is the revenue earned for processing cross-border transactions, which means when you go overseas and spend money using Visa card, it requires currency conversion, and typically Mastercard charges 1%, Visa charges 1.2%, and with all this China reopening, this international transaction revenue should probably stay elevated for a while. And other revenue consists of value-added service license fees for use of Visa brand, and the client incentive here are basically paid to financial institution client merchant to help them grow their payment volume itself. So it's basically a rebate to those financial institutions by Visa. In the recent quarterly earnings, we could see that the year-on-year growth for the first three main revenue segments has been slowing down. For service revenue, which often contribute to maybe 44% of the revenue, only grow by 10% year over year in the latest quarter. And if you look back at fourth quarter 2021, it was growing at 41%. So the growth has slowed down a lot. Data processing revenue, on the other hand, which contribute to about 48% of the revenue, only grow by 6% in the latest quarter. It was growing at around 32% in quarter 3, 2021. International transaction revenue is contributing to about 35% of the total revenue, manages to only grow at a speed of 29%. So probably this is one of the only one that is still growing nicely at 29% with China reopening itself. And having learned about the business model, you would understand that Visa would have been a high profit margin business because of the operating leverage Visa has. And the companies deliver super high profit margin itself. It typically is above 60% for operating margin and sitting above 50% for net income margin itself. And this is one of the things that I like about Visa, because again, not a lot of technology companies has been contributing high profit margin over the years itself. Lastly, Visa impressive free cash flow yield at 4.2% is one of the many reasons why I like about these companies. A significant amount of the free cash flow is allocated towards enhancing the shareholder value through share buyback and dividend payout. For example, in 2022, Visa allocated about 65% of the free cash flow towards share buyback and about 18% towards dividend payment. So basically, you can say that the free cash flow is normally got two purposes in Visa: dividend payment and share buyback. And main part of it is share buyback. Basically, when a company buy back their shares, it often leads to increased of earning per share and potential higher stock prices itself. So according to one of the value investor, Monish Pabrai, even suggested that buying back half of the share, half of the company shares can result in a 2 times return in the share price itself. So when you reduce the share count by 50%, the share price of the company will increase double. When buying back 60% can result in 3 times return. So suffice to say, Visa share prices have been increasing steadily over the year, and I think part of the reason is share buyback. Visa is actively buying back their share, reducing their share count by about 24% since 2012 itself. And I think the company share price can probably still stay elevated as long as Visa is still kind of like aggressively buying back their own shares itself. So I think this is one of the main thing about Visa that I like. Here is to show you the year-on-year return of Visa and S&P 500, Nasdaq, and Mastercard itself. And here is to show you the 10 years, the past 10 years maximum drawdown and volatility. There are a few key takeaways here. Firstly, since Visa IPO in the year of 2008, of all 14 full calendar years, Visa outperformed Nasdaq, outperformed S&P 500 over 9 calendar years, which means if you invest in Visa, 64% of the times, you end the year with the best performance. Secondly, Visa is quite volatile. Over the past 10 years, the maximum drawdown for Visa is about 36-37%, which is comparable to Nasdaq 100 itself, but probably is less volatile than Mastercard, which has a negative 41% maximum drawdown. And from the annualized standard deviation, we could also see that Visa is 25, S&P 500 is 17, Nasdaq is 21, and Mastercard is 27. And thirdly, Visa is outperforming Nasdaq and S&P 500 in the year 2022. You can see that Visa returned negative 3%, whereas S&P 500 returned about 18% negatively, and Nasdaq returned negative 32% itself. This is why some investors actually expect this year Visa to underperform S&P 500 and Nasdaq. But I just like to say that if you look back the year 2020 and 2021, Visa itself is underperforming S&P 500 and Nasdaq. So you could be looking at 2022 and think that Visa is expensive because it's not dropping as much as the indices in 2022. But if you look at 3 full years itself, right, Visa is probably not that expensive because it actually underperformed S&P 500 and Nasdaq in 2020 and 2021. This is why when you look at 3-year annualized return, you could see that Visa is 5% annualized return, S&P 500 10%, and Nasdaq 11% itself. So on a 3-year annualized basis, Visa is not expensive and could still be playing some catch up in terms of the return itself. Fourthly, I would say the market is fair. Higher volatility also bring higher return as well. In terms of maximum drawdown and standard deviation, Visa is typically higher than both S&P 500 and Nasdaq 100, but Visa has a higher annualized return at 18% relative to S&P 500 12% itself. And Mastercard, on the other hand, has a even higher maximum drawdown and standard deviation than Visa itself. But again, I would say that Mastercard actually provides higher 10-year annualized return at about 21%. So in summary, I think other than Visa, Mastercard is probably also one of the good addition to your portfolio based on the past return itself. They are also, I mean, Mastercard and Visa, after all, are largely similar in terms of the business model itself. And I think probably some investor would say to me that they prefer Mastercard because it's growing faster. But still, I would say that I prefer Visa because number one, I always like market leader, especially in the tech industry. Visa is the market leader in the payments industry itself. Number two, Visa is having a higher profit margin than Mastercard. Mastercard net profit margin is 43%, whereas Visa is 53%. And number three itself, Visa always, oftentimes, has a cheaper valuations relative to Mastercard itself. But I think both Visa and Mastercard are good companies. All in all, I would say that Visa to me is like Apple stock, always staying elevated in terms of share prices. Visa is now trading about 12% off its all-time high now. So it's probably not a bad time to invest. And some people would say to me that they probably prefer other names like PayPal because it dropped more than Visa, or other names like Square, it dropped more than Visa itself. But in the first place, Visa is not dropping more than other payment stocks because simply investors prefer Visa. You may ask, can Visa drop more than 20% or 30% off its high, like 2020 itself drop more than 30% of its high to provide you a better buying opportunity? Yes, it's possible. It's always possible that it can drop more than the current share price. But still, I would say that it's trading at a fair valuations now that you probably would like to allocate some in Visa. For example, if you are thinking of allocate 10% of your entire portfolio in Visa, now it's probably to invest part of it, like allocate 3% of your portfolio in Visa itself. And the remaining 7% you can wait for a better time if you want. For example, I would still say that we probably would anticipate a lower first half itself. So Visa along the way may actually drop some more. But could it drop lesser than other tech stocks itself because of its defensive nature? I would say probably so. So again, I would say that it's one of the better company, better tech names out there, defensive natures. Yeah. So that would be all. Let me go into the Q&A sessions. So if you have any questions at all, please type me in the Q&A box and I will try to answer one by one. Okay. Okay, I see a few questions over here. So is it a good time to buy Block now? Block is basically Square, like I mentioned. I think Block is one of the better payments stocks out there. I would say I like Jack Dorsey a lot as a CEO. I think if you want to invest in an offensive payment stocks, especially in the digital payment industry, Square is one of the best names out there. Maybe when I research more on Square, I'm interested to actually conduct a webinar about the company itself. One thing you probably would like to take note is Bitcoin revenue. Currently, customers can use the Cash App by Square to buy and sell Bitcoin. So I would say that to me, it's probably a better alternative to Coinbase because you buy Square, you have a better core business, a core payment business, and on the side, you got the Bitcoin business itself. But also bear in mind that the Bitcoin only contributes to less than 3% or less than 5% of the gross profit of Square itself. And currently, I would say that Square also owns maybe 200 million worth of Bitcoin in the assets. And they previously also say that they would buy more Bitcoin as an investment in the future. So I think the key things here to me is that if you really need to, I mean, you really need to have a constructive view on Bitcoin, because Bitcoin will always be an important part of Square, an important part of Block going forward. So going back to your questions, is it a good time to buy Block now? To be honest, I'm not so sure, because I basically think that S&P 500 will go down first. So Square, being a higher beta, smaller cap company, would probably correct more than S&P 500. And again, if S&P 500 goes down, Bitcoin as a risk-on asset will probably go down some more, or even more itself. And hence, I would say that it could further drag down the Square share price itself. All in all, I think it's probably best to invest in the defensive payment names like Visa, Mastercard first, before going for the other offensive names like Square itself. So I think the main thing here is probably you should ask yourself, have you had enough payment network companies? Okay. Okay, this is a tough question. Why does Warren Buffett buys more American Express than Visa and Mastercard? Okay, it's a good question, but I probably don't have a good answer for that. Probably I do not study Warren Buffett enough to tell you why he wants to own more American Express. But bear in mind that American Express not only has his own payment network like Visa and Mastercard, and competing with Visa and Mastercard itself, American Express also operates like a bank where you can open a bank account and borrow money from them as well. So I would say that Warren Buffett always likes companies in the mature cycle like banks. So probably this is one of the reasons he likes American Express. And but you also need to bear in mind that it also makes American Express more cyclical itself, and American Express is also under the financial sectors. So you can see American Express under the financial sector ETF, but not the tech sector ETF. But if I really want to invest in American Express, right, I would also need to consider other options itself, because since it belongs to financial sectors, I need to consider other banks like Bank of America, JP Morgan, to see whether American Express is it really better than Bank of America or JP Morgan. All in all, I do not want to complicate things. I prefer to invest in market leader in any industry. This is why I prefer Visa itself. Okay, I hope I answered that question. Okay, could you comment on Alibaba? Okay, lately we could see that Alibaba has reported their latest earnings. I think the main thing here is if you have already invested in Alibaba, there is no point here to let go of the stock since it has dropped so much, and let go and invest in other stocks itself. Because it has dropped so much that any point of the time, investors may just want to punt the stock, like what they did previously by pushing Alibaba up to $120 something from the previous low, I think $65. But if you have not invested in Alibaba, and if you have heard enough of me in the past webinars, right, it's not my favorite stock. I would say that it's always one of my least favorite stock itself. Couple of reasons why I don't quite like Alibaba. Firstly, I would say that it's in a low margin business and often has intense competitions. Especially nowadays, everyone is just competing with Alibaba. Like JD.com, like 1 week earlier, they announced that they want to launch a 10 billion yuan subsidy campaign to compete with competitors like Alibaba and Pinduoduo. And we could also see that Douyin lately is also launching the food delivery services as well to compete with Meituan and Ele.me itself. So intense competition is one of the things that I don't like. Secondly, if you were to look into the third-party seller business, is also not doing well itself. It is doing well in the first-party business, but this is one of the business that I don't think can bring out a lot of exciting growth itself. The exciting growth is third-party seller business, like what Amazon did with their 3P business. Thirdly, you need to look into the cloud business, because a lot of people look into the cloud business and value Alibaba itself. But Ali Cloud at the moment is growing at 3% in the latest earnings result itself. Whereas if you look at other global cloud providers like Microsoft and Amazon, it's growing faster at a rate of 20-something%. And I think that a lot of investors are interested in Alibaba itself, and probably I would conduct a webinar about Alibaba in the future. But just so you know, it's not going to be a buy call. Yeah, it would be a neutral call at best itself. Okay, I see some other questions, but again, we are running out of time, unfortunately. And probably I would type some of the answer in the YouTube comment or in my chat room in the uSMART app itself. And again, thank you so much for joining me today. And I shall see you 2 weeks later. Thank you all. Thank you.